The global REIT market rallied sharply, up nearly 14% last quarter, and outperformed equities as inflation and economic growth continued to moderate. This performance is consistent with our expectations of inflation fears being overblown and the REIT market being underowned. Our portfolio performed strongly in this rally, outperforming by about 250 basis points and up over 16% in the quarter. That brings our trailing one-year return to an excellent 32.5% for the fund, nearly 700 basis points better than the G-REIT index. Since we began this strategy, which happens to be exactly 5 years ago this month, we have outperformed the global REIT index by 730 basis points annually, an excellent achievement. The portfolio is really only positioned to invest in the best real estate opportunities that we see globally. Lately, that has been across a broad mix of real estate investment companies, with some of our largest overweight positions in non-traditional property types like cell towers, billboards, cold storage, triple net lease, data centers, and even single-family homes. These sectors give investors the key benefits of real estate ownership with differentiated and structurally attractive growth profiles and attractive risk-adjusted returns. We also have meaningful exposure to REITs in traditional property types like apartments, daily use retail, logistics sheds, and even the unloved office sector. Many REITs in these sectors are poised to benefit from what will likely be a very favorable supply setup as development has been curtailed in these core sectors. As demand is expected to remain stable in these sectors, they will likely enjoy favorable fundamentals. To show some high-level information in our portfolio positioning today, you can see that we hold just about 17 stocks in the portfolio with an attractive dividend yield of 3.8%, very strong forecasted growth of the same 3.8% per year for the next 4 years in unlevered operating income, modest leverage of 33% LTV, a significant discount to private market values or NAV of 10%, and an even larger discount to our primary valuation metric, intrinsic value, of 21%, which is derived from our capital market-based discounted cash flow model that values REITs as companies. We underwrite an attractive 18% annualized return for this portfolio on a 3-year hold as well, reflecting the high in-place yields and growth of the companies in the portfolio. Please also note that especially on our key valuation metrics of intrinsic value and expected return, the portfolio is far more attractive than the universe of G-REITs, represented by the FTSE Real Estate Index in the middle of the page. On the right, you can see 55% of the portfolio is invested in the US, with the UK the next largest real estate exposure, and we have very good diversification across unique property sectors in the bottom right. We changed preference for our holding in the triple net lease sector, moving to a higher yield player after our very high quality holding in this sector performed very well. We added 2 new positions in the portfolio in the quarter. One, a Spanish REIT that's taking advantage of data center development opportunity within its owned land portfolio. With ample renewable energy and a direct connection to some of the highest traffic fiber optic cable in the world, Spain is an emerging data center hotspot. The other company we added is a Canadian healthcare REIT that is poised to consolidate the very attractive seniors housing market, which is enjoying some of the best fundamentals in the world as demand recovers, supply remains low, and operating cost pressures fade. First, the dynamic that has driven strong returns for G-REITs lately is set to continue. REITs are under-owned and trade at undemanding valuation levels compared to equities. The disinflation dynamic we see playing out will underpin a central bank easing cycle, which will be a cherry on top for the attractive outlook for returns from G-REITs. Second, the outlook for real estate fundamentals is solid, underpinned by several dynamic real estate sectors that are enjoying strong pricing power and limited or declining levels of competitive supply. REITs are also in very strong capital positions and poised to grow their market share compared to private investors who are more dependent on bank financing. We're seeing this activity really pick up here recently. Third, the track record for this fund has been very strong. As you can see on the chart here, we have proven our ability to outperform in up and down markets over a challenging period of time, with an unrelenting focus on only investing in the best opportunities we see in the global real estate markets. We expect to continue to prove that we can help investors navigate the global markets while retaining the many benefits of including liquid real estate in your portfolios.